The two investment guys join us now, and we start with the world's second largest economy, Grant, China, and the news is not necessarily good.
No, the news hasn't been great for the last several quarters now. It's indicative of an economy that's slowing down, perhaps changing gears a little bit in that, for over a decade now, the Chinese economy was driven by investment capital. So in other words, that's all infrastructure, that's roads and railways and bridges and mines and power supply and all that kind of stuff.
And exports too, right?
Yeah, manufacturing facilities and all that kind of stuff. And that has an end to it in terms of you can only build so much capacity. And now what we're seeing is that is slowing down. It's reflected in the numbers. And the next take on all of this has to be, the consumer economy needs to pick up the slack there. And it is growing. It just takes a little bit longer to do that. The middle class in China is over 400 million people. That's larger than the entire population of the United States. But I just think we need to give that some time.
Okay, and Kris, let's talk about the U.S. dollar. That is, we're seeing strength in the U.S. dollar. A lot of people perhaps thinking that interest rates are on the rise in the U.S. where they're not anywhere else. That might be driving some of it. And I guess it's always a safe haven too, right?
Yeah, absolutely. It's a confluence of events, really. We're seeing geopolitical events around the world, Russia, Ukraine, the Middle East, and all of these things create that fear factor that causes a flight to the U.S. dollar. We're seeing a lot of money flow out of Russia. It's flowing into U.S. dollars. And then also, the fact, as you said, that it looks like the Federal Reserve is going to end their tapering program in terms of their bond purchases by the end of October, and then start to look to raise interest rates from this near zero overnight rate that we've been enjoying quite nicely for the last several years, probably by the middle of next year. So that will cause investment rates to rise and makes that economy look a little more attractive from an investment perspective.
And Grant, there is some more bad news. This Geneva report that says we may yet have another financial crisis due to all the debt levels out there and slow, stagnant growth. What do you make of that?
Yeah, well, I think the important part of that is that the debt levels are high, and that's always a cause for concern, because if you have a global economy that is stagnant and not growing, then high debt levels put you right on the cusp of perhaps another financial crisis. No, we're not in the camp that says that's coming, because what we're actually seeing is a long, slow growth trend line, and the data is a little bit spotty, but when you look back over a whole bunch of quarters, you can see that we're in much better shape than we were 2 years ago. However, the debt level, has risen almost as fast as the growth in the economy, and so those net numbers are cause for at least something to watch. I don't know. We're not alarmist on that, though.
Yeah. And Kris, you guys are always positive, of course, right? And maybe just give us the website for people who want to contact you guys.
Sure, yeah. We want to thank everybody for their questions and comments. Please keep them coming. Contact Grant and I at twoinvestmentguys.com.